Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, from foundational concepts to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, Head of Investor Relations here at Focus Capital, and I'm joined one more time by our VP of Investments, Chad Olson. Chad, people are going to start to talk and think that you're my favorite Chad here. Today's topic doesn't get nearly enough attention in investor education, in my opinion. It's become particularly relevant given what's happened to the rate environment over the last few years. Negative leverage. Most investors understand what leverage is in a positive sense, especially when it comes to debt leverage, using debt to amplify returns. But leverage can also work against you, and understanding when and why that happens and what to do about it is one of the most important concepts for anyone evaluating a real estate investment today. So let's start with the foundation. Let's do a quick review of a previous episode that I had done with the other Chad. What is leverage in real estate, and why does it typically enhance returns?
Leverage in real estate is taking on debt from a bank or agency loan financing. It's going to be you're agreeing to a fixed set of payments over a defined period of time. And the reason that enhances returns for equity is because you're going to take on, 60 to 70%. That cost of capital debt is cheaper than equity in almost every case because of the return expectations that go along with it. And so you're using the banks and lending money to be able to offset that thing. The equity is going to get the difference in returns. And those, fixed payments are usually based off of the current operations of the property to some extent. And so you're taking over at that, here's your leverage metrics, and then you're enhancing the income, the revenue from it, that benefits the equity investors because you've signed up, like I said, to those fixed payments to the lender.
Yep. Okay, so what is negative leverage, and walk us through the conditions that create negative leverage?
Negative leverage is the delta between whatever the going-in cap rate is and the debt interest rate that you're taking on to acquire that asset.
And does that occur at the very beginning of things? Does that occur later in the deal?
It can occur later in the deal, but that means you screwed something up. So it's generally coming in on the front end. So you are typically, we have an environment where people are willing to take that on for a variety of reasons. Usually the prevailing theory, and the reason we do and take it on, is because we look at an asset that is overburdened on expenses and operational and not extracting the value that they should out of it. And we see, but then the prevailing market and where it is and where the seller wants to get a deal done, that's the difference. And usually we're not talking about big swings, between the cap rate and that going in debt rate, where that's going to be. But we think that we find value there because when we take it over, we can lean out the expenses and operational cost. That will obviously drastically increase the cap rate. And then we also think we can increase the income. And so that's what you're trying to do. So as long as you have a solid strategy and plan, you can take that on. Otherwise, you're betting on cap rate compression and a few other things, and like large rent growth. That's not driven from the actual property level. It's driven from projections that may or may not be true.
So for our investors listening, that having negative leverage going into a deal isn't always inherently bad or a red flag.
But it needs to be something that there needs to be a solid plan that you feel good about, yeah.
And so part of that solid plan has, one, to involve with your trust in the operator, and then two, their track record. How many times have we purposefully done a deal where we started with negative leverage?
3 or 4 times.
And then what has been the general thesis on those deals specifically?
That within a year or so, you can significantly increase the income and reduce expenses to get on the other side of that.
Well, how does negative leverage show up in other deals? How does it manifest in a deal, and what does that look like for investors? I think that we've talked about the upfront underwriting. Is there any retrospective deals? Like you said, if someone messes something up in the very beginning where it didn't show up in the beginning, but it shows up in the end, could you walk us through one of those?
No, they would screw it up through the ownership process. That if their expenses go the other way, their income goes down, then they would have a deal that is assigned at that same cap rate. If the NOI goes down from where you originally acquired the asset, then that could do it. Yeah, it's really just operational that you're moving the cap rate, and the income that the property is putting off does not meet the debt service or gets tighter to that, and you're not making a 1.0. But then that triggers a bunch of loan covenants and everything else like that. because otherwise, if cap rates move, that's an opposite effect. So yeah.
So if a value add thesis is strong enough to overcome the initial spread, and like you said, we don't do big swings, but sometimes there is something. Let's say a deal is bought at a going in cap rate of 4.5%, and the debt is at 7%. Would that be considered a big swing?
Yeah, but do you have the percentages of it? So like again, the debt is only 60 or 70% of the total amount, and then you're taking on the interest only period too. So like, it's not straight apples to apples.
Yeah. So with that, let's say if the business drives up the NOI by 40% over 2 years, that stabilized cap rate on the original basis becomes 6.3%, which is much closer to that 7%. And that 7%, like you said, is only based off of the leverage portion, not the investor equity portion. And that spread then turns into a positive. So the question is whether the income growth thesis from the operator's perspective and from the investor's trust in the operator is enough to bridge that gap. What is a comfortable period, do you think, that you could hold a negative leverage in when it comes to evaluating a business plan for driving more income and stuff like that? Is it a 1 year period? Is it a 2 year period?
Depends on how you structure the model. If you hold reserves enough, then you can drive that out for a couple of years. It just depends on how you structure the model, how long your plan's going to take, and what reserves you're holding back to be able to compensate for that. Again, it's only a metric of that. If you have interest only, that can drive out the period longer. That's why you're negotiating for a longer interest only period to execute that business plan. But typically ours is all done within a year or two.
So a real world scenario played out in the 2022 to 2024 area where a deal moved into negative leverage mid-hold. How do operators respond? How did they respond? And what can an operator do on that side of things? And when it's something that's an unprecedented environment when it comes to the real estate world?
Just depends on what things you have. There's only two options that you can. You got to improve your expenses, your income, so your NOI, or you can recap it if the rates are lower than what you were locked in at. So if you took on bank or bridge debt at that time, but then, before 22, 23, before rates started moving, but even as rates started moving, they were still low. So you could take that on, recap it, and reset where your thing is, and then get back into positive leverage territory.
There are certain scenarios we haven't run into this, and we most likely will not. I mean, 99.9% we won't run into this, but there's also a scenario where there's a capital call where investors operators would bring on additional equity. So in extreme cases, operators may need to call additional capital from existing investors or bring in new equity outside to reduce the loan balance and restore the equity's ability to service the debt. But this is a pretty extreme scenario, and it's dilutive, it's uncomfortable, but I would say that it's better than a forced sale or a default on the loan. Is selling at a loss or accepting a distressed outcome the worst case scenario in any of these situations?
For the LPs, there's no real risk to them except for zero.
Mm-hmm.
So, but you don't want to throw good money after bad. So it really comes down to a decision at that time of what your options are. And if you think that the property itself is a good asset, you think it's just a timing component, and you're willing to take that risk and you have a good plan to get to the next phase and hopefully recover some of your money, then maybe that's worth it. But if it's not, and it's just nothing looks good, the debt options don't look good, the horizon doesn't look good, then it is better to cut your loss and let it go at whatever that price is. Try to get as close to even as you can.
Yep. I think that another thing that, as we've talked about in multiple episodes, how to evaluate an operator, how to evaluate their track record. I think it's very important to ask. An important question to ask is, when you see that there's a negative leverage going into a deal, like I asked, how many deals have we done it? What has been our thesis? what has been that business plan, because it's like, hey, on this plan, we're going in at negative leverage. Here's why. Here's where we think that we can improve those things. Here's where we did it before. I don't think that it's the biggest red flag or even something to be super uncomfortable about as an LP going into it, because it makes sense. It makes sense at that rate, especially when it's not their first time executing on that. Is there anything else that they should calculate when it's pretty apparent up front that they're going into a deal with negative leverage?
Just vetting out the pro forma and seeing what that plan is and understanding the thought process, having them explain it to you in detail what this operator is trying to execute, and then asking them for experience that they've done it before. As long as those things all match up for you, that's how you get comfortable with it, because that's the way it's driven, right? You can use it as a qualifying criteria if you need to, and that's on the investor's decision point. Like, nope, don't want to do these kind of deals. That's fine, but there is potentially a lot of upside and just getting deals done. It's the struggle that everybody kind of deals with across the board in the industry right now as we look for these pricing disparities across all things. It's like, if you just set that hard and fast rule, it would be great, but the market doesn't necessarily meet you there. The market is transacting at those levels on various deals from A class all the way to C. And there are people willing to take that down. They're getting deals done, and they're getting in the market. And we try to stay disciplined. We try to evaluate the best opportunities for all these different reasons. But if you want to hit those return metrics, you have to deploy the capital into a deal. So you've got to find that deal that makes sense. And that's where the plan comes in, the pro forma comes in, the stress testing comes in, the experience comes in, and the ownership in a market and the understanding of a market. All those factors go in. Very difficult to do if you're sitting on the coast trying to invest in the middle of America. But when you're on the ground, I think that's where you can find some of this alpha. And I think that's going to become more apparent and more important as we go on. But it's just meeting the market where it is, and getting capital deployed to be able to drive returns. But evaluating the pro forma in the plan more than the pro forma. The numbers are the numbers, they're projections. But just what is that operator's plan? How do they articulate it? How have they experienced it before? What have they learned from those experiences? What did you screw up on those last 2 or 3 deals?
Yeah.
And how are you going to implement those changes into this one? And if those answers all hit where you're looking for, you should be good.
Yeah, I think one thing that we kind of touched on, but kind of should flesh out a little bit more, is understanding the refinancing or exit assumption. Like in a negative leverage situation, when and how does that deal return to positive leverage? Is it just from driving income up, reducing expenses, or is there an assumption that I'm dependent on rates coming down or on NOI growth in both, or is it, and have they pressure test those assumptions? I think that if the assumptions are fully dependent on rates going down and being able to refill, and be able to refi at year 2 or year 3, that's an issue. I think that if it's a small combination, like, hey, it's mostly based off of NOI, and then it would just be an extra bonus help, like a little padding there for rates to come down, I don't think it's the biggest flag. It's something to definitely earmark. But I would
have a lot of discomfort. I want to really understand that refi scenario.
Yeah.
I'd want to understand and see all of those numbers that go into it, and I'd want to understand what rate they're putting into it. And if that rate doesn't have a lot of spread in it, I wouldn't. And then I can see that it's at least returning the capital. Add defined DSCRs, and then stress test those DSCRs for, okay, if your plan doesn't work out, what is your rent growth over this time? Like, you have to start working backwards into every one of those things. And this is the difference on why we don't do like 3-year holds. We will sell a deal in 3 years if it's going great. We'll do that. But we don't project that, because making and executing a plan in a year, 2 or 3 years, way more difficult than executing over 5.
Yeah.
You can have ups and downs in 5. You can have way more ups and downs in 10s and recover and do the whole thing. But in 3, that's very difficult. And that's what you're talking about in a refinance situation, is getting it done in 2, looking to refinance by 3. It's a very hard cycle to get done, that you really want to vet out the sponsor to make sure that they've done that before and executed and what their thoughts are. And it's very easy to throw in a refinance situation and say the DSCR is 1.2 with 24 IO and base that DSCR off that IO number, and you're going to have a problem because you're not going to hit that. And I would just period, full stop, not invest in a deal that had rate reduction refinance. I would not do that, period. It's not worth the risk.
Yeah.
Especially if the returns are, I mean, if someone showed me like a 20 or 30% IRR, and if I flipped it myself and the numbers still worked out and I liked them, I could maybe do that. But I'd want to have a conversation with them about
Yeah, no, definitely.
and stuff. But it's just not, it's really not in the cards right now. And my guess is that with that, it doesn't sit in its own vacuum that the returns are it means they're going to be pretty lean and that there's lofty expectation. They don't sit on their own. It's going to be 3 or 4 other assumptions in there that are pretty aggressive that make that thing look the way it does. And if you take all those away, suddenly that deal is not worth doing. So it just makes me very cautious.
On a deal that you're going into with negative leverage and it already has a high occupancy and is relatively well managed, how do you anticipate, increasing NOI at that point?
I don't think we would do a deal like that. It has to have all the other factors that go with it. Mm-hmm. Some of the bigger companies and the big institutional buyers that are buying up assets, they're typically buying negative. Mm-hmm. They also have bonds. They have some other stuff that go out there to re-leverage it and stuff, but they are looking at it on a purely operational side.
Gotcha.
So they're just going to reduce expenses because they can do it with scale.
Yep.
So there is a component to that, but I just don't think that we're the group to do that kind of a structure. It's got to have upside in income, upside in other income, some expense reduction to some degree, and then rent drivers.
So a larger group that can have, at scale savings when it comes to also having property management in-house, asset management in-house, basically.
Or just hundreds of thousands of units.
Or hundreds of thousands of units, yeah. And it's something where it's like they don't need as many, key footholds in the deal as a group like we do. And so when people, because we're talking about people that are investing not just only with us, but in any type of syndication, those would be areas where it's like, yep, they could probably drive some operational costs down from just purely scale alone, without having to affect, if the vacancy is already healthy / occupancy is already healthy, if it's a newer build and rents are relatively where they need to be, there's not a lot of pushing that you can do on the income side. So the only pushing that you can do is decreasing operational expenses, which then obviously captures more of the existing income. So.
Yep.
Heard. Is there anything else that you think that we should talk about when it comes to negative leverage? Anything that LPs should consider when looking at a deal with negative leverage? We already touched on the fact that negative leverage isn't inherently bad going into a deal. It can be part of the business plan, and if the operator shows exactly how they're going to increase that income or decrease expenses, or a combination of the two, which will then flip that leverage within X period of time. Again, depends on the hold, depends on the business plan. That it is still an investment to consider. Granted, some people just are like, hey, that's a personal thing of mine. I don't invest in any deal that has negative leverage, period, and that's fine. Is there anything else that people should consider when looking at a deal that starts out at negative leverage?
No, I think we covered it.
Okay, perfect. Well, looking forward to having you back on this podcast and in future episodes. Thank you so much for your time over the past 4 episodes. I guess August is coming up, Chad Olson, huh?
I like it.
All right, thanks. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.